Welcome to the NWR Virtual Investor Conference, May 2020. On the line, we have Tribeca Nuclear Energy Opportunities Fund. Tribeca's Nuclear Energy Opportunities Fund aims to provide investors with capital growth by investing in companies involved in the nuclear energy industry, with a focus on the uranium sector. Established in 1998, Sydney-based Tribeca Investment Partners is an Australian-based boutique fund manager with a reputation for delivering on-performance targets. With us today, we have Guy Keller. Guy has 20 years of global commodity trading experience, having worked in London, Singapore, and Sydney. He spent the past 15 years as a director of Macquarie, most recently in Singapore as head of the Asia-based metals trading desk. Guy has run trading strategies across base metals, precious metals, and iron ore, and he has an extensive network of industry contacts that includes producers, consumers, and physical traders, as well as global commodity and macro hedge fund managers. Over to you, Guy. Can't wait to hear from you.
Thanks, Laura. Thanks very much. And to those in this time zone, thanks for taking some time away from homeschooling your kids, and anybody else tuning in from another time zone. It'd be great if you just give me half an hour or so before we're cracking that second bottle. Right, so we're going to get into uranium, and I mean, before we get into the nuts and bolts of it, I mean, the basic real headline grabber here at the moment is that you've currently got, and you know, it's as a consequence of COVID, I think, but also a deeper problem with the market itself. You've currently got 50% of monthly mine supply offline, and with, unlike any other commodities, there's only a really small incremental loss in demand. So put that into perspective. There's no other commodity in the world that's currently in this situation. We've already skipped through who we are. We're going to talk about the nuclear fuel cycle and the uranium industry, nuclear industry. Just very quickly, I mean, this is a reminder, I think, when we talk about demand loss and uranium, that there actually is, it's not like, for example, coal, where you know, it goes from mine to a ship to a port to a power station and can be burnt tomorrow. There's actually a long process that can be up to 2 years to take it from uranium to the fuel rod for the reactor. So slightly longer term thought process involved in this thesis. As you can see here, the commodity price performance year to date against you know, uranium's a standout, even outperforming gold, which has been a darling to a number of people. And again, you know, I just want to reiterate that short-term demand for uranium does not fall in this period. There's still baseload electricity being generated from nuclear, and unlike other commodities, you know, for example, copper, zinc, all of those commodities where the supply demand, the supply shocks you've seen from COVID are outweighed almost by the demand loss from the world shutting down. This is a more recent price history. As you can see here, the uranium price is now at more than a 5-year high. We've finally broken through that $30 barrier. And we're seeing a lot of parallels to previous bull markets, you know, in that the biggest tier one low-cost producers are coming offline as a result of just the market dynamic being broken. So, you know, you could see here, there's been a few handbrakes. COVID-19 obviously has been the spark, but the reality is, again, you've got Cameco's 2 largest mines off. You've got Kazatomprom cutting production. Again, the 2 biggest, lowest cost producers cutting production in this market. You know, it's saying something. You know, we've already seen a good spot price response since the lows in 2016. But if you compare this to some of the other price responses for some other commodities in the past, you know, we've got a 25% supply cut here in uranium. And, you know, I mean, yes, we've rallied 80%, but we're still well away from the incentive price that's going to bring any of those pounds back online. I mean, I can't emphasize it enough as to the moves we've had here are constructive in spot, but it's still not solving the problem for the utilities. And the problem is they're going to need uranium, and at these prices, there's nobody incentivized to produce it. Since we launched our fund, we've had a number of handbrakes that have been specific to the uranium sector and the nuclear industry. More, most of that coming from the United States with the Section 232 investigation, morphing into a nuclear fuel working group, which was then had extensions and expansions and delays in reporting. That, with other President Trump actions at the time and trade wars going on, that created a lot of uncertainty for US utilities, especially, who are the biggest consumer of uranium. And that uncertainty then sort of followed into European utilities, who sort of felt that they didn't need to do anything. But at the same time, whilst this was going on and the Western world was sitting back with trade wars, there were plenty of other countries that were busy locking up supply, and that's important. So, but that handbrake has now been released. We've seen that policy announcement, and it's broadly supportive for the US nuclear industry. And we've had a number of other, as I said, sort of COVID was the spark that has lit this match where the fundamentals just don't match up and causing us to rally. We'll talk quickly about supply. Again, you've got Cameco here that are currently producing 75% less than they were in their peak in 2017. Kazatomprom is now 20% less. You can see on the chart on the right here that mine production, primary mine production of uranium was falling over the last few years as a result of low prices. And then this COVID-19 has just put another big hole in this supply equation. If we look at the more recent COVID, this is the care and maintenance and supply cuts since 2013. It is in order. And as you can see here, we had sort of incremental pounds coming out due to low prices post Fukushima. And then we had, a few of the big boys, Paladin with Langer Heinrich, Cameco with McArthur River, Kazatomprom with across the board supply cuts. And if that wasn't enough, we've now had these two yellow lines to see, almost 70 million pounds of primary mined uranium coming out of the market. The thought process that this stuff can come back on quickly and easily, again, it's slightly misguided. It's not just going to be price. There is a commitment for contracting that Cameco has said time and time again that they want before starting McArthur River. And then there's, we're probably a 2-year wind up for McArthur River to get back to full production. Kazatomprom, not only do they want higher prices, but they want committed purchase volume. So they're not just going to turn back on and hope that the buying turns up. They're going to turn back on because the buying has asked them to turn up. And Paladin as well, they have said for Langer Heinrich to come back on, that again, they would need at least committed prices in the mid to high 40s. They're also going to need to raise some capital, and they've got a mine restart. So you're not seeing pounds coming back into the market in a hurry. And as for all of this cumulative stuff that has come off since 2013, pretty much all of that needs much higher prices to be kicking back in. We've got the cost curve here. We've seen care and maintenance of the grey lines, and as you can see, we're looking down here in the lowest part of the cost curve. And then when we add on some of this COVID supply loss, if you take all that out, we're probably looking at about 110 million pounds of primary supply this year versus about 135 million pounds last year. And you've got to remember as well that the demand is just shy of 200 million pounds. We're looking at anywhere between 190, 195 million pounds of demand that is currently being made up by inventory drawdowns and secondary supply. So we're going to have a big deficit this year because Kazatomprom have already basically indicated that they will not be able to make back their lost pounds from their COVID disruption, which is 10.4 million guided. And Cameco are very unlikely to make up their lost pounds as well. This is from the WNA Nuclear Fuel Report. We've taken that data. They use, as we said here, they use 3 demand scenarios: lower, reference, and upper. And you can see that we've that WNA have defined that. You know, they must have entirely plausible as representations of future events. Now, I mean, not only have you seen here in 2020, I've taken that big chunk out that we're going to lose. But then as you start looking forward here, even on the lowest demand, so remember the blue lines on the bottom are the current supply, the current mining that's happening. The red, the green, the purple, and the light blue are the care and maintenance, they're under development, they're planned, and they're prospective. Anybody that's been around any sort of mining game for any period of time is going to know that you need a lot of those things to go right, not just price. You need permitting, jurisdiction, capex, you know, management teams. You don't want construction delays. So assuming you get even all of that going right, you're only just making up, you know, into 2020 to make up 2023 lower scenario demand under the WNA model. So, I mean, there's a massive gap here, and only these scenarios that is not currently, you know, anywhere near planning to come to production. So again, it needs much higher prices to get not just those other colourful lines to come to market, but the other stuff that that the WNA doesn't currently anticipate coming to the market. If we touch on demand quickly, you know, you've probably seen some of these sort of slides before. Operating is about 200 million pounds. Under construction is about 25 million pounds required uranium. The planned reactors are about 50 million, and then you know, proposed. So if you get all of this happening in the next 10 years, you've suddenly got a demand of around 400 million pounds a year. That's double what it currently is. I like to bring that back into, again, you know, pounds required. So again, this is just this bit here. The number of reactions, the 54 reactors currently under construction, are going to require the chart on the left amount of uranium per year. And I'm not even including the fuel load factor at the beginning, where we've made a note there that they require 3 times the amount because they put, you know, the way they fuel up new reactors. But when you look at the ex-China number of reactors being built, you need another McArthur River, Cameco McArthur River mine, 18 million pounds a year. You need another one of those to come to market in the next 5 years just to satisfy the demand coming from the number of reactors currently being built. So not the current reacting operating fleet, but the new ones coming to market. And then when you look at China, for example, the red bit on the over this side, you know, they need another one and a bit more Husabs, which is their flagship mine in Namibia, that they've had varying degrees of success in bringing up. When you bring it into perspective to, I mean, we've got here, I've put here Honeymoon, it's Boss Resources project in South Australia. You know, it's a brownfield project, one of a handful that we think will come to market in the next few years. And you look at what that can supply. You know, maybe it's getting USA and Belarus. You know, there's even what they're bringing on is a drop in the ocean compared to what's going to be required. We talk about this a lot. Why has there not been a rush to the market with all this news and the price action? And quite simply because utilities are running down inventory, and they're also running down their supply contracts. There's a whole another subject matter that we could spend hours on talking about this, but the reality is, you know, it doesn't make a huge amount of sense running down inventory at the low point in the market. You know, common sense would tell you that inventories should be for when material is scarce and prices are high. And also it should make more sense to engage in more contracting at lower prices. I think the disconnect here obviously is that the spot price is so much lower than the incentive price that the miners need, that it causes utilities a few headaches with boards and CEOs and CFOs and discussions as to why am I going to lock in at $45 when the current spot price, well, you know, 6 months ago was 25. So, you know, there's a whole level of complexity there. I mean, China is the big X factor in demand. Say what you will, you know, you can count reactors coming off in Europe and on and off or on and off in Europe and the rest of the world, but China's a big driver. And being around commodity markets for over 20 years, the one thing that's always constant is when China makes a structural change into something that requires a commodity that they're short of, that commodity doesn't go down. And we've seen here, you know, we've got a paragraph here as to what the current 5-year plan is. You know, they're missing their 2020 target of 58 gigawatts because they've had a delay in new reactor builds. And as you can see here, the last 3 years, China have basically connected 12 new reactors to the grid, and a number of those are firsts in reactor design for China. So it was always our view that again, knowing how China operates, they're not going to rush out and suddenly go and build 100 of these brand new generation 3+ reactors without knowing that that the first one they built is safe, can be connected, and operates as it should. So the last 3 years, we've seen success from China in getting those 12 reactors into the grid and producing low carbon baseload electricity 24 hours a day, 7 days a week. And as a result, on the right here, you've seen that they approved another 8 new reactors last year after that 3-year halt. 5 of those should be beginning construction this year, and we expect more approvals eventually at this year as well to start next year. Of the 12 that they've got under construction, again, when you're looking at time, people often say, well, this is a 2025 story. You know, China's got 3 reactors coming online this year, 3 next year, and 3 in 2022. So there's 9 of those 12 are on in the next 3 years. And then, you know, 1 annually for the next 3 years after that. You know, and of course that then, as more gets started this year, then that 2023 to 2025 or 2024 onwards, more likely, has more reactors starting. So there's going to be a constant, you know, movement there. When you look at even their current plans, they're still 35 gigawatts short of reaching the top end of their 5-year plan band. So, you know, again, that's roughly another 18 million pounds of uranium that would be required if they do that. A lot of misconceptions around the market. Inventory, I call it available inventory. Cameco spoke the other day on their quarterly as to mobility of inventory. The one thing I can tell you, again, being around commodity markets for a long time, is that it doesn't matter how much inventory is available, is in the market or being counted. It's what's available, and to Cameco's points, what's mobile. You know, we've seen, in fact, this year we've already seen, you know, physical markets around gold and crude oil doing different things as a result of, you know, misunderstanding about available inventory or where that inventory needs to go. You know, as you can see here, a vast majority of that inventory is sitting with nuclear utilities. The Americans like to hold around roughly 2 years. The Europeans a little bit more. The Koreans about 3. And you know, we've talked before. They're dragging that down, but over the last 3 years, and should be continuing so far this year. But that inventory doesn't come back to the market. It's not like the price gets to a certain level and a US reactor is going to go and sell their fabricated fuel rods, because one, they got to find a reactor that it fits, and that's probably more pertinent to Japan. Regardless of how long Japan takes to come back on, it's higher cost. It's already fuel rod, most of that. So you know, it requires a whole bunch of process on that reverse engineering of that cycle to get it back. You know, China's the big black hole. It will continue to accumulate inventory. You know, say what you will about whether they want 5 years or 7 years or how much they've got. You know, in the West, the mantra for a nuclear fuel buyer is don't run out of fuel. In China, the mantra is don't run out of the next 10 years of fuel. As well, they've learnt their lessons from other commodities and will be prepared to hold strategically a lot more uranium than the critics would want us to believe. And again, electricity demand. I mean, you know, the good thing about this industry is we've got a really long, you know, project line of what we can see in demand growth. And when you look at these numbers that come from the WNA, one of their reports, you can see here that out to 2035, they're assuming that the nuclear mix stays at 11%. So you've got 1.5% compound annual growth of a really big number because it's global electricity, and you're assuming that your nuclear share doesn't change. Well, we know that China is looking to move theirs from, you know, as we pointed before, to roughly 20%. Sorry, 10% from about 5%. Japan's got plans to switch their nukes back on to be around 22%, I think. So, you know, they're really big numbers that we're looking at, and there's a lot of growth coming out of non-OECD, which should be supportive for nuclear. We talk, you know, I'll just touch quickly on this. Carbon emissions, low carbon baseload power. The other competitors on the left-hand side are all intermittent sources. So, you know, you want 24-hour a day, 7 to 8 days a week electricity, you know, that's carbon neutral, then nuclear is your only choice. There's a small blurb here about Germany have gone down. I mean, and again, there's so many great case studies about what's been good and what's been bad about this industry, and you know, and some of these case studies are phenomenal. With Germany, they've gone renewables. Their electricity prices tripled, or twice expensive as France. Their carbon intensity has gone up. You know, people say that the cost of capital to build these big reactors is large, but again, as this report from the WNA also points out, that when you look at the life cycle of a nuclear reactor, which is 60 and in some cases 80 years, compared to the life cycle of renewables, you've got to replace those renewables 2.5 times over the life of one nuclear reactor. So, you know, you can't sort of turn around and say the cost is X and you're comparing different things. You need to, so that's what that sort of chart there shows. Again, USA, another one. You know, nuclear capacity factors. It's you know, one, the CO2 emissions they avoid by having 20% of their electricity provision nuclear. You know, it's 20%, but it's 55% of its low carbon electricity production. California is a great study. Again, they've gone down the renewable path, and I'm not saying that I'm anti-renewable. There's a place for renewables in the grid, but you can't make your grid dependent on renewables. And there's some little stats there just about land size. You know, 75 square miles for solar to replace nuclear reactors that are being shut down. 360 square miles of wind, of land required for wind. So, you know, again, there's trade-offs for all of this, and there's perfectly good examples that we can look at here. Japan, again, back to that inventory slide, we view Japan as neutral. Yes, they have been slower to restart because they are requiring some very stringent anti-terror changes to be made to their reactors, and so they should. But again, you know, as I said before, the inventory there is not going anywhere. So we view Japan as sort of net neutral. If they switch them all back on, it's great because they'll consume the fuel that they have in inventory. But if they delay a little bit more, that fuel's not going to become available to the market. Oh, that's us, but we'll skip that one. You know, if we look here, you know, I get some pushback to say, well, you know, everything's performed quite strongly right now. We've just taken our portfolio, you know, March 23 was a dark day for everybody in financial markets, including the uranium and the investment strategies around that. You know, we've had a very strong recovery from those lows, as you can see there. We've just basically taken the average share price. So we haven't weighted our portfolio or anything, and there's still, you know, 255% more price appreciation in the stocks that we hold to get them anywhere near the 5-year highs that the spot price currently is. You know, and you got to remember 5 years ago when the spot price was this high, it was on the way down. You know, so there's still plenty of upside in this story. And then just very quickly to wrap up, you know, we've got a pretty broad portfolio mix here. As you can see, I've got a price history of just the of UPC our substantial holdings in Yellowcake, but UPC's got a better price history, and we expect them to perform the same. You know, just by sitting still here, even if it does sit still, there's still that ability for that 25% discount to fill in to NAV, to bring those sort of the UPC or Yellowcake anywhere near raising again. You know, so there's 25% upside straight away from there, before they're going to be anywhere near the market. And as I said, you know, we've leveraging our flagship Global Natural Resources Fund. We've got access. We are global in that fund as well. So you know, we've basically seen just about every deal flow and raising event in the uranium space in the last 2 years. We've accessed some of them, we've passed on some of them, and not because we don't like them, but because maybe the timing's not right. You know, we've built a warrant book, we've got some pre-IPO stuff, we've got the ability to look at physical derivatives and also debt in the space as well, which will be the next big thing as some of these projects look to come back to market. So I'll leave it at that. I mean, again, this is just, we're in the global resources space. We have a process, and that process is much more important, I think, in uranium, especially around permitting and jurisdiction and community, where, you know, uranium is not necessarily a favourite amongst communities and governments and things. So, you know, we look very closely and follow this approach. So I'll leave it there, and if there's any questions, I'm happy to answer some.
Thanks, Guy. Just in the interest of time, on your last slide that you were on just before this one, you did have a couple of companies. So maybe if you could talk through your, you know, your top 3 uranium companies that you're interested in that may be able to take advantage of the uranium market upswing. They may not be those names, but
yeah, we don't sort of talk about too many of the companies we own. I mean, it's fair to say we've got sort of 14 positions, so it's fair to say we've got a reasonable cross-section globally. I mean, we're obviously substantial holders in Boss Resources, which I mentioned before, so that's public. I can talk about that. You know, that's on that list of brownfield exposure. That's sunk capex already. Fairly low amount of money that's required to come back to market. You know, good ISR project in a good jurisdiction with permitting. You know, so that's obviously a substantial. Yellowcake is a substantial holding for us. We participated at IPO level there. Again, you know, that suits us, this first phase of the investment thesis, where it has to be the spot price moving enough to get things interesting. So that's leverage to that. And you know, currently with it trading at that discount to NAV, we think there's a you know, 25% upside on. What
about in Africa or the USA projects? Any names you'd like to point out there?
The only other name that we're substantial in, so that we, you know, can publicly talk about is Bannerman in Namibia. Obviously, it's a very large resource there. You know, it's slightly higher cost, but I think that's sort of a bit indicative of the country. However, it's sort of shovel ready, and just gives us some good leverage to, you know, that pounds in the ground sort of revaluation, and also, you know, it's people talk about China, you know, wanting to be in other jurisdictions. It's the most obvious and easiest place for China to continue to consolidate their footprint, because they're already there, and the government's quite supportive of them being there. Whereas some of the other jurisdictions where there's mining or prospective mining operations, it's not going to be as easy for them. So we like the exposure to that sort of angle as well.
Thanks for the presentation today, Guy. We'll be following along the Tribeca journey over the coming months.
Yep, no problems. Thank you.
Thank you. Up next, everyone, we do have Vital Metals. Vital Metals is targeting rare earths production from its Nacalico project in Northwest Territories. Stay on the line or buzz back in. We'll be back soon.